So let's just jump in here, and I want to start by just doing some basic stage setting. So what is marketplace lending? Why is it growing so fast? And what problem are you trying to solve, and for whom? So we can start with Jeff.
Yeah, I'll start on the what exactly marketplace lending is. Essentially, it's, if you think of the way traditional finance companies and banks have provided capital, particularly to consumers and small businesses, it's been leveraging their own balance sheet. So they'll take in liabilities, wholesale funding, deposits in certain circumstances, go out, source the borrowers, perform all the operations, but at the end of the day, the risk of the underlying collateral sits on their balance sheet. I think you've seen in larger capital markets transactions for the last 30 years, there's been a shift from on-balance sheet to the actual capital markets themselves. What marketplace lending has done, and what a lot of our business models are really built around, is taking it at a much lower level. So we can take a $15,000 personal loan and bifurcate it into $25 increments and have a retail investor fund that loan at the time of origination. And I think one of the major benefits for that is the risk threshold of that capital is perfectly aligned with the risk that you're providing. And so we'll have loans as low as a 3.99 APR, and we'll have loans at a 25% APR. They have different corresponding loss rates and different capital risk thresholds. And what marketplace lending allows you to do is, at that time of origination, you can plug in the capital that wants that exposure in a way that's perfectly matched. And contrasting that with what happened, I think, in the financial crisis in 2008, when the wholesale markets dried up and most specialty finance companies went out of business, a lot of that was because they had the mismatch of the assets and liabilities. And so I think that's one of the really powerful components of marketplace lending. And from the funding side, I'll let my colleagues answer from the borrower side.
Well, I agree very much with what Jeff said. I mean, it's a lot about liquidity matching. We're matching people one-to-one rather than like banks, taking deposits and lever things up and owning the risk on their own balance sheet. But to the other part of the question is what's the problem we're solving? I think, there's two kinds of borrowers on, I think, both of the consumer-oriented platforms. I won't speak for the small business guys, but there are people who are looking for access to credit, and there are people who are looking for a really good rate to pay off a higher rate product. So we see in our high FICO bands that there's a lot of rate sensitivity, and there are people who are looking for a really good rate that reflects their good credit, that will allow them to take a 19% credit card or even higher if you've missed a payment, and put it into a 5, 6, 7, 8% term loan with a fixed payment and a fixed period, so you can just get that off your books. We also see in the lower FICO bands, we see people who are actually using this product as access to credit, and these are people who have we've always sort of underwritten down to about 640, so it's like the 640 to 700 FICO band, and there are people that if they tried to get a credit card, they would get like $1,000 line or something like that, and we can actually score them, risk them, and give them the product that actually offers them $5,000 or $10,000. And so they're actually getting access to credit where they couldn't get it before. We see more repeat business there as well. And that's really a segment of the market that I think post-2008 the banks really abdicated. If you have anything under like a 760 FICO and you try to go to a bank and get an unsecured loan, they're going to ask you what you're going to put up for it. And this is what we do is unsecured. And so we're able to give people that opportunity to finance the things they want to do in their life.
And I guess chiming in on the small business side, I think access is part of the story. And one of the nice things about a marketplace model is you can kind of fill in parts of the credit spectrum that maybe a bank wouldn't be playing in. In our case, actually, a majority of our borrowers could theoretically get a loan from a bank if they wanted to, but they're coming to us because of experience. We can turn around a financing decision inside of a week. And for a small business owner who has a pretty high opportunity cost on their time, that's a really important distinction. 40% of our application activity actually happens outside of the hours of 9 to 5. So it's providing a whole new novel form of access, not just for people who wouldn't have access to bank credit, but also for people who would prefer kind of a digitally first type of experience.
I think there is an imbalance, though. The elephant in the room is that you're selling most of your loans to institutions and not to other peers now. It's really morphed into a whole different place. Can you guys talk a little bit about that?
I mean, Jeff, you know what? I'll start. You know, I think there's a reason why the two peer-to-peer lenders that really achieve scale and success on the consumer side started with retail, and we have this special SEC registration that allows us to fractionalize and issue the loans in $25 increments. It's because professional investors, institutions, high net worth individuals, they need to see data, they need to see track record, and so we've been in the trenches actually doing this for 10 years. And we built up a huge, valuable data asset that allows us to underwrite loans better than even a lot of banks can do it. And the retail was an integral part of our DNA, and we couldn't have done it without retail participation on the platform. Now that we have that data asset, it's become more attractive to a broader set of professional investors who look at it, they look at the track record, they realize that the underwriting is actually really excellent, and they want to buy it, they want to own it. Those guys show up with, in the beginning they showed up with a couple $1 million. Now they show up with hundreds of millions of dollars. And it's not that we have given up on the retail investor. It's that when you're bringing on, $5,000 investors one by one, and then you have a retail guy show up and say, I want to buy $500 million worth of loans, there is naturally going to be an imbalance, and it's really hard to make sure that you are you're being fair, and we randomly allocate. We make sure.
Yeah, I think it's good news actually for the industry, because I think that it shows the level of depth. You have a lot of people who are on the retail side who want to be part of it, and they're not.
These are people who have leverage covenants, analysts. They're looking at risk. They understand what we're doing. So it's a validation, and a lot of those loans ultimately are making their way into retail portfolios of publicly traded entities or wealth management accounts, stuff like that.
I want to hear from Noah, because he has slightly different models, so maybe not considered marketplace lending, but online lending. So can you tell us what you do and who you're helping?
Sure, yeah. So from an OnDeck perspective, we were founded really, literally the name of the company. When the bank turns you down, we're on deck. So by definition, we were serving a market that hadn't been served by capital before. It wasn't about sort of refinancing folks from one product to another. And we needed to work with professional investors who understood that risk. So from the beginning, we raised money from institutional sources. Now, to sort of Aaron's point, we have an OnDeck score now that's on its 5th generation. We've made over, well over $2 billion in loans to these small businesses. So now with that data asset in place, we've been able to steadily evolve our relationships with those institutional investors. So in the early days, OnDeck would have all skin in the game, and we would be putting up, say, 20 or 25 cents for every dollar we lend. That number's come down to 5 cents, and we've also added the OnDeck Marketplace, where now investors are taking the risk and buying the loans right off of our platform. So that evolution has now happened in our business as well, but because of the very different origins of our business versus some of the other folks on the panel, we thought that was the right evolutionary path for us to go on. And I do think the distinction of retail versus institutional is important, but I think all of us are looking for really permanent and uncorrelated capital bases, such that if any particular set of investors were to drop out, on the flip side, you would see other investors who are stable enough for us to maintain operations, because times are great right now, but we all have to be thinking about what happens when the economy turns and how does our capital structure look in that environment as well. And I think that's where the institutions and really designing that capital base is so important.
And retail investors have proven to be more sticky and stick around, right, through the tough times?
That's what they say.
They were there in your early years.
Yeah, no, I mean, Prosper has been through the downturn, but it was a completely different underwriting model. It was pre-SEC registration, so it's hard to draw a parallel.
So I want to talk about some of the drivers of this growth. There was $9 billion last year in online lending, and projected to be $20 billion this year. So what's driving that? Is it millennials and changing customer behavior? Is it that banks have stepped away and are not making loans like they used to? There's also distrust of banks after the recession. So what do you think are what's driving the growth?
I mean, I think it's the online model is really driving the growth. I mean, we've made it really easy to apply for a loan, to get a loan. We're like from application to funding, we're averaging about 3 days right now. You don't have to, put on a sports jacket and go into the bank and fill out a form and ask for a loan. You can really do it online and get an instant decision. So I think that there's there's a lot of conversion of people from this idea of I have to go into this brick and mortar bank and apply for a loan to get access to credit to, hey, let me shop around online. And a lot of the guys who aren't here who are feeding some of this business are the aggregators like like Bankrate and Credit Karma and LendingTree who are driving traffic to the sites as well. So there is this flywheel effect online of efficiencies, lowering costs of customer acquisition, getting more offers out there, and for us it's like top of funnel. We look at it and higher conversion rates. And I'll pass that along. But
I think it's the arbitrage that you're able to make on avoiding a lot of the regulations that the banks are subject to.
Oh, my next question. So is it regulatory arbitrage, or are you really that much better?
I think I'd like to challenge the fact that there's regulatory arbitrage. I mean, you have to think of what's the purpose of regulation. So on the one hand, we aren't a bank. We don't take in FDIC insured deposits. We don't take those deposits, put them into risky loans. Every loan that's ever made is risky. I mean, there's a chance it's going to default, right? What we do is we line up an investment opportunity on the other side. And so I think what's critical is that the investment opportunity, just like any other investment opportunity either retail or institutional investors have, actually has the proper disclosure, right? And are representing what the underlying risks of that investment are. And through our SEC registration that we have for the retail product, we actually fit within the existing regulatory regime, right? The SEC regulates investments. We are registered with the SEC with respect to our retail investments. Then you go to the borrower side. What are people worried about on the borrower side? And it's, are you basically taking advantage of consumers? Are you taking advantage of customers in some respect? All of our loans are issued by a bank and therefore subject to the exact same banking laws that Citigroup would be subject to with respect to how they deliver that product and service to borrowers. So at the end of the day, you have to think of what is the risk that regulation is not looking out for right now? And if there is a big area of risk, then maybe that could be subject to regulation. But from the consumer compliance standpoint, we fall within a regulation regime there. On the investment side, we fall within that. The difference, again, is that we don't take in FDIC insured deposits, and so we're not stewards of government-backed money.
Mm-hmm. And I should point out that you and Prosper have a higher level of regulation because you're dealing with retail investors.
Yeah. I'll just jump in. I mean, the barrier to entry for this is actually really high because of compliance regulation. We as a private company have public company filing requirements. We are registered in every state that we allow investors to invest in. We're registered in every state where we allow borrowers to borrow money. We do work with a bank partner, but the bank partner basically makes us do all the compliance work. So the legal and regulatory burden for a private company like ours is way bigger than it would be if we were just a tech startup.
To add on to it, the way I view it is we've got 103 regulators because we've got the states on lending law, you've got the states on the security sides, and you've got federal regulators. So the notion that this is an unregulated space, I do think is a bit off. I very much agree with Jeff's point, though, that by not having FDIC insurance, there's kind of a different paradigm, the fact that we're not too big to fail. There's not the moral hazard potential, and so the regulatory paradigm is a bit different. That being said, for those of us who've partnered with banks, as I think pretty much all the platforms have, you have to bring your systems to that level of compliance anyway. So if you do want to be actually large and scaled up and part of the financial infrastructure, as I think all of us kind of aspire to be in many ways already are, you kind of have to bring the business to that level of compliance standard anyhow.
I think the real arbitrage is actually in the operations of the business. So we don't have branches. We're doing a lot of stuff online. We have applied technology to new businesses that allow us to underwrite and set up accounts way less expensively than it would take like a Wells Fargo to underwrite a mortgage. And we're taking a lot of the costs out of the business. We're in businesses where where the spreads are fairly fat, and a lot of that goes back to the borrowers and the lenders. And that's why we're able to add such a value proposition to both sides.
Yeah, I mean, I was going to add to that as well. I think just because we derive advantages from being a non-bank doesn't necessarily mean it's regulatory arbitrage. I was on a panel with a bunch of bankers. We were talking about technology and systems. And I was saying, well, OnDeck's about 8 years old, and we've built all of our systems in that time. And they're all built from scratch, purpose built really for making small business loans very efficient. And then someone else made a point about, well, our system's been around for many years. I go, how many years? 20. Surely that's a lot of years. And they kept going like this. 30. Nope, even more like this. You literally have some banks where at these core systems, the people who understand how these systems work are retiring. So I think the arbitrage, if anything, is agility. And if you look at the models we've all created, we've been iterating on them so much quicker and building new technology so much faster than the traditional players have, who are encumbered by regulation, encumbered by a branch network, encumbered by capital requirements that we don't have because they are safeguarding people's money. That I think it's a much broader structural dynamic that's creating our opportunity than simply regulation, which is undeniably a part of it.
Do you want to push back on that?
These guys, all I can say is these guys are more defensive than
They're
Bruce
pretty
Lee on
persuasive.
PCP.
Whoa.
I really think you're right, though. I think you're all correct. I think what's happening here isn't so much regulatory arbitrage as a cost advantage that you're creating by not being bricks and mortar and by being able to connect people more directly and eliminate the middleman as much as possible. Along the journey, you have become the middleman for the banks. You've got a lot of banks joining on because they don't have the nimbleness or agility. Over time, we'll see how that happens. But I think the market, and when I look at investing, I see the market as being very deep. And I see a lot of people wanting to jump in, but they want to see it proven out the way you guys are proving it out. And I do think that when your company goes public for $8.5 billion and it's everybody's seen stars in their eyes, I don't think the valuations are really as crazy as people think the valuations are when you think about what's going to happen in the future. Whether you'll be the gobbled up or the gobblers, that's the real question.
I'd like to talk a little bit about how your underwriting process differs from that of a bank. That's part of the agility arbitrage too, right? Your technology, you're using data in new and different ways to underwrite in a way that banks aren't. But can you elaborate on that a little bit? Like, what does your underwriting look like compared to a bank's?
Yeah, I mean, I'm happy to. So I think the FICO score was discussed a little bit earlier, and the FICO score is universally in consumer one of the core ways that people do underwriting, and it's sort of a lingua franca for creditworthiness at this point. In small business, the FICO score has been notoriously unreliable.
I like the word lingua. I don't know why.
It's the only Latin I've got.
That's
yeah,
pretty good.
so
I like it. You looked at me when you said it. I don't know why.
Yes.
Yeah.
We can talk after the panel.
Okay,
if you like.
sounds good.
So anyhow, in small business, the FICO score is notoriously misleading. You've got false positives and false negatives, right? Someone's great at paying their mortgage. They're terrible at running their restaurant. On the flip side, people use personal credit to build up their business. Just when they have a thriving business, the FICO score doesn't give them credit for the business they've built. So what the OnDeck score really tries to do is actually not dissimilar from what traditional bank underwriting does. We just try and do it really, really fast. But it's a holistic picture of the P&L, the balance sheet, and the cash flow of that business. We also have the advantage of being able to scour the earth for online data sources that give us additional filler kind of around that core model. But really what we're trying to do is do a real-time debt service calculation on a Main Street business just with a much lower cost than it would take a human underwriter to do that at a bank.
I think one of the most interesting things is if you think about just the application process itself, and a little over a year ago, we also entered the small business space. If you go into a Wells Fargo branch and you want to get a loan, your experience is this: you walk in and you say, "I'd like to get a loan," and then they'll say, "Okay, come back and bring a mountain of information." So then the small business has to go home. I mean, people that run small businesses are very busy people. They have to go home, gather up all this information, then they give it to the bank, and then the bank ships it off to a centralized facility, and maybe 2 to 3 to 4 weeks later, you'll get an answer back, right? Why don't you just flip the process on its end? Why don't you say, okay, you self-report what your information is, and then we're going to present an offer to you believing what you told us is true. And you get the instant gratification at that point in time that you'll get the offer and you know what the offer is. And then on the back end, we'll do the verification process. So just simply switching the application process on end drives much better customer satisfaction because the small business didn't waste a bunch of time putting in loan documentation only to get denied, right? And it's also faster and less expensive for us because we will only do the back-end verification work for those borrowers that actually submitted an application and agreed to the interest rate and the loan terms that they got. And so it's a much better customer experience, but it saves an incredible amount of cost, which at the end of the day, if you think of the costs of lending businesses, there's the cost of credit, people that don't pay back, there's the operations cost, there's your cost of capital, and if you can take that operation cost significantly down, I think that's really what's driving the growth of these businesses.
Okay.
Yeah, I think on the consumer side, I mean, when we look at it, FICO we don't even actually use FICO in credit decisioning. It's a guardrail. So we just say if you're below a certain amount, we're just not going to do it. But we have, the question about was, how is underwriting different and where do we start? We have, we pull the customer's credit. We're on the 5th generation of our underwriting model now. And we've been using about 40, 45 specific data points to come up with a custom scorecard. But the data is now so rich, and we can actually do look backs and look people up and see if the people we turned down turned out to be a correct decision or an incorrect decision. And so we're actually writing our 6th generation now and applying some of these modern data sciences techniques to it. I think we're using something like 400 data points now, and it's getting really accurate. And it's if you plotted a curve of right decisions versus wrong decisions from FICO, we're way up and to the left from there now. So.
Interesting. So I wanted to get back to the regulatory issue a little bit and talk a little bit about the differences between how different countries and different regions are approaching this alternative lending space. And the UK in particular has seemed to have embraced it with open arms, especially the government of David Cameron. Do you want to talk about that, Sam? Because I know they've lent through
Sure.
your...
Yeah, so Funding Circle's active in both the U.S. and the U.K. Been around for about 5 years, and actually are very excited that the UK government, through the Better Business Bank, actually lends through us. And we've actually been pushing for basically the adoption of online lending standards, and particularly marketplace lending standards, because up until about a year ago, there really weren't regulations. In the U.S., we have a situation where a whole kind of set of very old securities regulations as well as lending regulations are slightly less old, basically apply to us as a category of lenders. And so we've, as a set of platforms, basically had to figure out how do you piece together a model that's going to be fully compliant. Now, as Aaron said, that's actually powerful, because to the extent that you can do that, it's a pretty meaningful moat that prevents other people from following. In the UK, they actually have a simplified regulatory framework that allows marketplace lenders with a pretty reasonable amount of regulatory capital to kind of get set up, and provided you follow reasonably straightforward disclosure standards, operate a business all of what we're doing, but do it in a slightly different format than kind of a traditional securities company, which we do think makes a lot of sense and actually has been a major boon to that sector taking off in a meaningful way in the UK. On the lending side, the UK government has also been very proactive in advancing kind of non-bank lending as a supplement to what banks are doing, to the extent that actually some folks of the government right now are working on policy measures that would actually mandate banks to send their turndowns to non-bank lenders, simply because they've seen banks pull back so much, particularly from small business lending. So very different regulatory environment there versus over here in the U.S.
And one more thing about that, these sort of investments are covered under their retirement accounts, right? So people can invest in marketplace loans through their retirement accounts. That's very hard to do here.
That's also very correct. The ERISA rules in the U.S. are not easy. In the UK, there's kind of a straightforward pathway there. And then the last piece is losses are actually deductible from a tax perspective, which is also a meaningful boon.
Well, I'll put in an ad for Lending Club and Prosper. You can open IRA and invest in our loans if you want, and it's a really good tax treatment.
But it's still hard. You have to do the self-directed.
It's kind of a pain to,
It's a lot of
Once you set
paperwork.
it up, though, it's
paperwork.
Okay. All right, well, let's move on to banks. They still have the lowest cost of capital, right? And they have the customer relationships. So if they decided to get aggressive about lending again, they could make this a good fight. But at the same time, we've gone from sort of talking about banks as dinosaurs to talking about banks as partners. This year, we saw that at Lendit, there was a lot of talk about partnerships and announcements. But either way, their business model is being deconstructed. So what do banks look like 10 years from now? How do they respond? And are they just a front end to marketplace platforms at some point?
Who are you asking?
Whomever wants to take that. Jeff, why don't you grab that
I'll
one?
talk about why we've been partnering with banks. I mean, I think in 10 years, I think what you'll see is an increasing amount of specialization and partnerships that happen, right? I mean, every bank in the country does not build their own ATMs. Every bank in the country, surprisingly, you guys probably don't know this, they don't actually run their own credit card programs. Other banks run their credit card programs for them. What they're really good at, or what they thought they were really good at, was commercial real estate loans in their cities. But I think what you're going to see is really trying to partner with best-in-class organizations, whether it be OnDeck or Funding Circle on the small business side, us on the consumer side, because we bring that level of specialization, and we're willing to partner with them to give them the operating efficiency, access to data that they just can never match. I mean, if you tried to get our engineers, right, best-in-class Silicon Valley engineers, and if you asked them, would any of you guys like to go work at Wells Fargo, you wouldn't have a single person that would want to do it. I don't see how Wells Fargo competes with that. I think the way that large and even small banks are going to have to compete with it is knowing what they're good at and knowing what they're not good at, and stick to their knitting. And where that could lead, Lou and I were talking about this earlier, is it's not inconceivable that a large bank could become a marketplace itself, where if you want a checking account, you get the checking account through them. If you want a credit card, you could partner with someone else who specializes. You want a small business loan, you partner with someone else. And at the end of the day, the bank could be the aggregator of a lot of specialized products and services.
Yeah, I actually really think that model is interesting. Someone said a phrase a couple weeks ago to me that stuck in my head, which is the idea of banks as a utility. And look, we all are reliant on the banking system on this panel to move money. They do have a lower cost of capital, but this idea, I think the smartest banks will be the ones who figure out how to open up their infrastructures in such a way that best-in-class partners who bring more of this technology-enabled angle, who bring that focus on making a particular product experience best-in-class, and who don't view the sort of coming of this industry as a threat, but really view it as an opportunity and kind of an inevitability. Because that branch model of banking is going to go away. Even if all of these companies in this panel didn't exist, the banks are going to be cutting out branches left and right. I mean, 80% of banking transactions are already online and mobile. It's the complex transactions like lending and mortgages and what have you that just haven't moved online yet, but they're going to fall soon. And once they go, there's really no reason to have the branch.
But they have moved online quite a bit. I mean, if you look at mortgages
data,
in particular,
absolutely.
but the data that you guys are collecting is just the most fascinating aspect of what's going to bring us forward. What do you? Can I ask the question? What are you seeing here? Can you ask them what are you seeing in data? Here. What are you guys seeing?
From a macroeconomic perspective?
Yeah.
Or,
What are you seeing?
it's
Who are your borrowers?
Yeah, we see some really interesting things. I mean, I guess the good news is these platforms are starting to get big enough where we actually think we have a lot of leading indicators of the economies. For example, someone's FICO score, we typically can see it drop 6 months before it does. Why? Because stress in their business leads to stress in their personal life, and they can't pay their bills, and their FICO score drops. So we see that. On the plus side, we see certain parts of the country that are having booms in construction. Why? Because loan applications from residential and electrical contractors are increasing. We see other parts. We saw the port strike, play out. We saw issues that we talked about at one of our earnings calls with some of the oil production states, with North Dakota, Oklahoma, Texas. So I think the data is fascinating. Sometimes we get asked, will the data ever be a business of its own? I think we're not prepared to go there yet, but I do think over time all of these platforms are going to have awesome opportunities to use that data in different ways.
MasterCard Advisors
is a real, yeah.
I mean, they're real. They take their data. That data is reported. They trade on that before they ever release it. So why aren't you guys doing the same thing?
I mean, I think in a way we are. I mean, when we go out and we work with like super regional banks to work with them on creating what we call private marketplaces, or helping them make credit decisioning. We may not be white labeling it or renting them our model, but that's what they're in it for. They basically, the first step in a partnership is, anonymize, show us your data, prove that the underwriting is good, and when they get in there and look at it, they're like, yep, you do this better than us. Let's do a partnership. Let's find a way for you to help us keep our customers. And we'll fund the loans that make sense for us. The rest that don't fit with our investment criteria can go into the public marketplace. But a lot of these banks, they cannot serve their customers. They've realized that having a term loan product doesn't actually cannibalize your credit cards. And if you're not there to help your customers get that credit, they'll go somewhere else and then they're gone. Right? So they're willing to partner to do that. And so in a way, they're leveraging our data.
I actually think that is the tie-in between the two questions, the one Amy you'd asked and the one you'd asked, because it's frankly, it's some combination of data, technology, and distribution that are making these platforms interesting from a partnership perspective to banks. And ultimately, banks, I think, realize for the most part that it's very not cost-effective to try to do sub $250, maybe even sub $500,000 term lending, and many forms of consumer lending as well through their existing physical distribution. Just too many man hours, just way too much expense. But if they can partner with platforms that have the digital distribution, they can make real-time or near real-time decisioning, or at least offer and kind of eligibility provisioning, and then help those borrowers have a great experience online in a way that doesn't threaten their core business. That's a very powerful offering.
Great. Well, since technology is one of the huge advantages that you have here, and we're talking about competition and banks, but banks are not your only competition or your only potential partners. So what about technology companies, Amazon, Apple, Google, who you're already partnering with, Jeff? How do you view them? What's stopping them from getting into, I mean, some of them are already in payments. Is lending next?
It could be. I mean, some of them already are. Sorry, Amazon is certainly providing lending services. I mean, you think of just who does it make sense to essentially get into a lending business, excluding the regulatory aspect, right? It's, do you have customer relationships, and do you have some unique data that allows you better underwrite the underlying risk, right? And if you think of those organizations like Google or the partnership we did with Alibaba or others, they actually collect very interesting data that traditional banks don't have access to. And so if these organizations can leverage that data, again, regulatory piece aside, I mean, you saw what happened when Walmart tried to get into the banking system, right? I mean, people went crazy. So I think there's an element of that. But they have a lot of very valuable data. And at the end of the day, I think that's what's going to drive a lot of these businesses. Now, whether they do it themselves, whether they do it through partnerships, whether Amazon will team up with Citigroup to try to leverage that data and get the capital from Citigroup, I don't know how that ultimately plays out. But given the assets they sit on, there's definitely a lot of value there.
Tell us a little bit about what you're doing with Google.
So the Google relationship was interesting. It's effectively, they have value-added resellers that they needed to provide financing for. And so this particular project was essentially us being the rails for that lending to happen, but the capital itself was provided by Google. And so you could see situations where large organizations that have problems that need to be solved want to put up their own capital to solve those problems, but they don't have the regulatory rails and everything else built to support that. So they could come to organizations like us to really facilitate commerce, right? And that's another way to think about it is partnering with organizations like that can make commerce easier and done at a much lower cost.
Yeah, I mean, I was just chime in on the big tech players getting into lending per se. I think it's a lot less like, I think they're really interested in payments. They're really interested in being part of the system. I've happened to know the guy who runs the Amazon lending product. That's pretty big, and it's really interesting for them because what it really does is allow them to use their data to increase inventory turns of the merchants on their marketplace, which ends up them selling more stuff. So it makes great sense for Amazon. The question is, how does Jeff Bezos react when one day he wakes up and he's got billions of dollars worth of debt on his balance sheet? And I think that's really the limiter here, is that these technology companies are really highly valued, and they're not carrying a lot of debt. They're not, it's not, GE Capital is, as you know, is coming apart as we speak. I don't think these guys have an interest in becoming really big lenders. I do think that the people who are in payments maybe more naturally will tend towards like small business lending because of the relationship. But I think they end up partnering with some of the people on this panel to dispose of those assets because they don't want to hold them on their balance sheet.
I mean, we've talked to most of the technology companies that serve small business owners in the U.S. and also in Europe. And we've heard consistently is they're much more interested in partnering than trying to go direct. I mean, I certainly think that what Amazon and PayPal are doing in terms of small merchant financing is really interesting, and I think it's part of the solution for small businesses. But it's not really competitive with what any of us are doing. In fact, it's really complementary in a lot of ways, because if you can accelerate a small business's working capital cycle, they can turn their inventory faster, get the business growing, that actually creates the parallel demand for expansion capital of some sort. So I do think you'll see some technology companies doing interesting things around credit. But I think to Aaron's point, the notion that they're all of a sudden going to become specialty finance companies, it's probably not anytime soon.
Okay, I wanted to talk a little bit about some of the broader issues that are being discussed here today. So the luncheon panel talked a lot about inequality and lack of economic opportunity as big issues facing this country. Access to capital is certainly a big obstacle for a lot of entrepreneurs. But we're starting to see evidence that underserved communities and women and minorities in particular are having better success on some of these alternative platforms like online lending and crowdfunding. So my question is marketplace lending a great leveler that can democratize finance, or and are you seeing, what are you seeing on your own platforms? Are you seeing more participation by women and minorities? Are they having higher approval rates?
I guess what I can say is we have a very broad base of borrowers, both from an ethnic and a gender diversity perspective, and also from a geographic diversity perspective. We pretty firmly believe that access to credit shouldn't be constrained by where you live or who you know. And I do think that there are vestiges of the banking system where it's about who you golf with, which I do think makes it harder for people to get access to credit and other financial products, which are really important as as one grows their business. The nice thing about being digitally native, about being data driven, a lot of those factors that kind of traditionally were tacitly involved just aren't involved anymore. And so I do think over time it does provide economic on-ramps, not just for women and minority borrowers, but frankly for a whole host of, in our case, small businesses who just need expansion capital.
The model's actually, is truly blind. When you were asking the question, I was like, I don't even know, because we don't factor,
So we're not allowed to factor it in.
Yeah,
Exactly.
Well, nobody's allowed to do it, but when you have humans involved in the process,
right.
it happens
Exactly.
anyway. There is, there is bias, whether or not it's overt, but a computer doesn't do that, right? So we're just applying an underwriting model. Everybody's kind of the same, but just the data points, and so to that extent, maybe there are obviously, and we're really. Us and Lending Club, we're really mainstream lenders. I mean, we're marketing all over the country. We're lending in 47 states, and so there's, we have banks that want to invest in our loans because it helps them meet their Community Reinvestment Act criteria, simply because we're just, we're everywhere. So it's, I guess it is leveling to a certain extent.
I think over time, clearly, it's a democratization, but you also have the ability. You're going to see there. We don't have that many really high-quality websites yet in the lending space. They tend to be right here, and they dominate. And so whenever you have a market that's underserved, there will be someone who will come in and try to feed that, whether it's a new tranche that they're able to sell or if they need to target it. But right now, that's a very interesting data point that take out the human error and you actually get a better distribution of loans.
I mean, it's startling. Women get one out of every $23 that are in small business loans that are lent out.
Actually, there's a really funny early on deck story that we originally thought we would distribute our product more through community banks, which turned out to be totally wrong for a host of reasons we don't need to go into. But one of the more interesting situations happened when we declined the brother of someone who ran the community bank, and the guy was up in arms about it because, of course, my brother should get a loan.
Do bet to Billy Carter that happened.
Exactly. So but it's just it is a much more blind process, and we don't release these statistics publicly. But generally speaking, we see overrepresentation relative to banks. Because to your point, it's almost a ridiculous underrepresentation in what you see in traditional banking. And I think it's interesting that we're competing with, quote, judgmental underwriting. But the judgmental, you're not just judging the business. Often people are judging the person, and that there's flaws in that process that these platforms don't have.
Okay, let's talk about scale. The numbers are huge. There's money pouring into this space, but you're still a drop in the bucket compared to the overall market. Consumer lending, small business lending, commercial real estate. So how do you scale? Jeff, why don't you take that?
Well, I think you do it. The reality is you do it sort of one day at a time. These are massive markets. I think one of the risks that we're constantly worried about is just operational risk. If you look at our growth chart, it almost looks fake because it's so predictable in terms of the growth, but that's precisely because we know how many people we need to hire in 3 months, and we know that it takes a month and a half to train them, and it's really getting the right people involved to be able to scale these businesses, because we need to scale them to be able to handle volumes significantly larger than what we currently have today. I mean, at the end of the day, we're still operating a business, and businesses can only grow so fast. So
I agree. I look at it in that way also, which is it's around picking the responsible growth rate and not overgrowing the market opportunity. I mean, if we look back at the last financial crisis, there are obviously many lenders who blew up because they just outstripped their systems. They outstripped the liquidity they had ultimately, behind the platform. And I think, certainly the platforms up here, all of us are thinking about this or trying to think about it in a very long-term way. And so that means making sure you've got the right, core systems. You're thinking about credit appropriately. You're understanding where we are on the cycle. You're diversifying and making more permanent your funding sources, and you're picking a growth rate that allows you to manage all of those things, because frankly, managing all those things is somewhat challenging. It's really driving operational scale while doing those things is hard, but I guess that's also the fun of it.
What about just making the raising the brand awareness? I mean, the Lending Club IPO certainly did a lot for that, but I think as Ron Suber said at Lendit, he locks people in, when he's on an airplane and after the door closes, he asks, people if they've heard of marketplace lending, and most of the time they haven't. So it's not a household word yet. So when are you going to start, TV advertising?
Has Ron been tossed off an airplane yet for that? Ron's here.
Yeah, I was going to say.
We can switch places if you want. But the fact of the matter is that this is not an online shopping site. We don't want everybody in the world to come and buy stuff. We have an underwriting model that we have to adhere to, and so you do to the point that was made about scalability. You have to make sure you're still accepting the right people, and you're still doing the right amount of underwriting and verification work. So you don't want to. You're just not. This is not a come one come all. And actually, the people that actually end up coming organically get disproportionately turned down for credit, because they're sort of people who are actively seeking it generally don't look as good as people who are responding to an offer. And I'd say most of the people who are responding to an offer actually don't really know that they're borrowing necessarily from a marketplace lender yet, right? Because a lot of the collateral you get in the direct mail kind of all looks the same because that's what works. But I think you're going to see more offline marketing and brand awareness type stuff, but not like evocative Coca-Cola type, dreamscape stuff, more ROI focused awareness stuff. I mean, you've seen Credit Karma doing it and it works very well. It's really, we're in a response driven business. We want to target a certain type of person and get them when they're ready to make a credit decision, and not waste a bunch of money on people who don't fit.
What about global expansion? And do your underwriting models carry over if you're going that route?
Well, I think it was said earlier at a panel this morning on Digitizing Wall Street, I think it was Mike Weil who said it, that if you want to see what's happening, what the future of banking looks like in America, go look elsewhere. Because the rest of the world develops a lot more quickly. They don't have the kind of regulatory markets that we have, and and risk is adjusted as a result. But they say look outside, and perhaps that's why China's interesting, but the Brits have been doing it for a while. Europe's been active, and we're catching up. It's kind of like infrastructure, the privatization of infrastructure. It's the same phenomenon. It happened in the rest of the world, and then we just raised our taxes too much, so now we have to do it too.
I could comment a little bit on the global phenomenon. So we, sort of have three markets we've disclosed sort of publicly. So we have the U.S. We've been in Canada on a pilot basis for about a year, and we announced that we'll be launching in Australia later on this year, a couple weeks ago. And I think there's two things that stand out from our experience so far. I think one is the banking systems are very different in these different countries. The U.S. is a wacko outlier in terms of 10,000 banks plus credit unions. It's remarkably fragmented. When you look at Canada, there's a couple, maybe a dozen banks that matter, and really a very small group that kind of control most of the market share. Australia, the number that controls most of the market share is 4. So much more concentrated. But what we have found is that small businesses, there's a universality to the small business access to capital problem. We've had people go apply for small business loans in different markets around the world. It's not a great experience, kind of no matter where you are. And all small businesses kind of have at their core that P&L, that balance sheet, that cash flow. So a plumber in Canada and a plumber in the US and a plumber in Australia might have more similar dynamics. So we've actually found with relatively little investment, we were able to get our first outside the U.S. market up and running well, and we're very confident that in Australia the same conditions will hold.
And similarly for Funding Circle, we currently operate in the U.S. and the U.K., but as we see it in a lot of parts of the developed world, and certainly many parts of kind of the less well-developed but rapidly developing world, access to credit for small businesses is a pretty universal problem. And that's in part because banks are globally regulated in very similar ways, and so they've pulled back from certain pockets of lending. And it's also partially has to do with the experience point that Noah is speaking to. This isn't just about offering credit to people who aren't getting credit from banks. It's about delivering credit to people in an experience that actually makes sense, meaning it's the time of purchase or it's fast enough where it actually means the opportunity cost of going through the credit decisioning process isn't so high that it's a major barrier. So we anticipate expanding into other countries beyond the two that we're currently in. Can't say specific plans yet, but probably in the medium term.
I just just one fact that I don't know might make you really excited for the future of marketplace lending or scare the crap out of you for where we are in the market. But we learned 2 weeks ago at Lendit that there are 2,000 peer-to-peer lenders in China. The largest of which actually alone did more than all of us on the panel last year put together, over $10 billion. And so that's also a very sort of futuristic market from where we are. But from a consumer perspective, we're kind of focused on the U.S. as from a Prosper thing.
Okay. So I've got a couple more questions, but if the audience has questions, start thinking about them now, and we'll take them in a minute. We touched on this earlier, but I just wanted to get back to it again because it's very important. But marketplace lending, has done very well in this very favorable environment. So what happens when the next downturn hits, when interest rates rise and investors stampede into the next big thing? How resilient is the model?
Well, that's what I think about every day, frankly, is there going to be enough investor capital to continue to fund our originations? And you can almost think of it like we're in the asset management business, right? At the end of the day, it's about are you sort of delivering on what you say you're going to deliver on? And what are your returns relative to other returns available in the market? So if we went through the Great Recession again, and you were invested in LendingClub loans, and you've got 3 times loss coverage, and in the last credit crisis, the losses were 2x what they originally, you're still going to have a 4% net return, right? At the same time, your equities are down 30% in the market for a reason you don't even understand, right? You understand if someone doesn't pay you back, you get it. I'm a retail investor, it makes sense. Twitter goes from 70 to 30 and back up to 50. They can't understand that. And yet there's no issue and no concern about, particularly on the retail investor side, continuing to fund the loans. So, our theory is we think high net worth individuals and retail investors will be sticky because it's at any point in time, it's a relative game.
For me, though, just to counter that, you don't have the liquidity you would in the stock market. There's no real secondary market for this yet. And so that I know is the holy grail for a lot of people to generate the secondary market and then, again, make a little cash on the turn as it moves through.
Rather than comparing it to equities, we compare it to balance sheet lending. So I think everyone here is moving towards a marketplace model or started that way. And in a downturn, if you're a balance sheet lender, you are dependent upon lines of credit and securitization markets, which are usually the first things which basically shut down. And then that's why you see specialty lenders basically hit the wall and die and then start losing money very quickly because they're doing loss reserves for loans they made before that aren't paying off anymore. And I think that one of the theories that we have is that, to Jeff's point, the underwriting model is pretty good and consumer credit did very well during the last downturn. The credit card portfolio has actually rebounded quite nicely. But that we'll be able to continue to fund loans if we have the right diversity of investors, retail, high net worth, asset managers, and people who maybe it won't grow as fast, but you can continue to survive and issue loans through a downturn. Then you can show a more resilient model by spreading out the risk than relying on securitization.
But will a secondary market help you guys?
I think, well, yeah. I mean,
So we have a very active secondary market in the UK because it's just much easier to facilitate one, such that if any holder of one of our loans wants to go and sell, they can do so instantaneously. There are very tight bid-ask spreads on the secondary piece, and we actually think that over time, having a robust secondary market certainly is helpful from just a capital formation perspective, because it means that for investors who have some duration concerns or some liquidity pressure, there's a way of managing that. I think there are really two separate questions that we're talking about, though. One of which is, what is the credit performance in a downturn? And I think that we now all have enough data. We've now done enough stress testing of our books where we should all be able to say, kind of within a bounded range, what the loss levels are. And that, I think, is why we've been able to attract institutional capital at this point, capital from very serious investors who really understand the way credit markets work. The second question is around liquidity, which is historically the main reason why a lot of specialty finance companies have blown up, for the reasons that Aaron laid out. And for us, and I think for a lot of folks up here, it really is around diversification and permanence of capital sources. So it means some investors who can come into the marketplace and we're actively picking and choosing loans or pieces of loans. Also other investors who are coming in and saying, I'd like to have an all-you-can-eat arrangement where I just have a big pipe. Any loan that meets this credit box, I'm willing to buy. Also doing things like setting up captive asset management businesses. Lending Club was actually an early innovator in doing this through LC Advisors, and I know a number of us have more recently looked at doing things like that. Figuring out permanent capital vehicles like an investment company or a BDC or a closed-end fund. Those are the things I think over time which will give us all a diversity of different ways of forming capital and weather whatever liquidity crises may come.
Okay, and I wanted to touch on one more thing. There have been some issues regarding transparency, and this is particularly in the small business and short-term small business lending space, where it can be really difficult for borrowers to figure out how much they're actually paying, what their rate is on an annualized basis. And Noah, I want to flip this one over to you because you're kind of in that space. But how do you, does that hurt the industry as a whole, and how do you get a handle on that before regulators come in?
Yeah, so I think it's a really interesting question, and I think it's where small business needs to even be bifurcated in two ways. So there's long-term small business loans, like bank loans that might be 3, 5, 7 years, and actually the market that OnDeck evolved out of was the shorter-term lending market, right? So loans of typically 6 months or 12 months, and so the challenge there is obviously one of rate versus cost. So our loans are very inexpensive on a cost basis. You'll pay 2 cents per month for every dollar you borrow. But when you annualize that rate, it looks very high. So our average APR is 50%, which is a number that makes people's eyes pop. So what the short-term lenders in business have largely elected to do is market their products on a cost basis. It's not just OnDeck, it's American Express, it's Square, it's PayPal. All of us do it. So the question is that transparent or not? What we find from our customers is that the cost-based marketing, they do understand what they pay. So the interesting thing about APR is that 50% actually really overstates the actual dollars they pay on the loan. For example, if I rented a car for $100 a day for a week, that would be $700 in expense. I wouldn't say the cost of that rental car was $36,500. So there's a distortion effect going on, and what you see is that in installment structures, once you go beyond 2 years, then the APR looks lower than the cost. So if I'm marketing long-term loans, it's to my advantage to market APR. And if I'm marketing shorter-term loans, it's to my advantage to market cost. Our feeling is that we want a level playing field. To the extent the industry agrees on common disclosure structures, I think we're very open to following that structure. But right now, if I were to say, hey, you know what, I'm going to spend my time convincing people that a 3-month loan where I might pay 6 or 7 cents of total interest and explaining the difference between that while my competitors don't have that burden, that's a tough place to be. And so what we've elected to do really is for our longer-term products, our 2-year product, our revolving product, those are marketed in APR. For our shorter-term products, they're typically marketed in cents on dollar.
Okay, great. Thank you. Do we have any questions from the audience? We've got a couple minutes. Okay, right there.
Does brand matter in loan origination?
Yeah, we definitely think it matters. I think with direct mail, I think Aaron's definitely right that you got to hit them when they basically need the credit. But there's a big population of borrowers that we go after where they're not coming through direct mail, for example. And I think where that drives a lot of value is even on the investor side. So when you think of and it may mean more, because what Lending Club stands for from an investor side is similar to what T. Rowe and Fidelity and every other large asset manager out there. And if you don't have that brand and it's not a place that's trusted, then you're not going to give your money to make investments. And so I think it's critical.
Similar question actually for Sam and Noah. I mean, are you heavily reliant on the equivalent of an ISO network, or feet on the street with your own sales force or contracted sales force? And if so, how do you use the elegant technologies you've built in credit decisioning to help try to drive down the costs of client acquisition?
So we don't use an ISO network at all, nor do we use outside sales at all. The majority of our acquisition is direct. So I send loads of direct mail. I do a lot of online digital advertising. Beyond direct acquisition, I also have a pretty broad partnership network, which also sends through a lot of the loans that we end up funding. Our goal is to do all of our credit decisioning and, frankly, all of the borrower experience, have that be completely controlled kind of through Funding Circle, which, as it stands today, is exactly how it works.
I think for us, so 75% of our origination is sort of direct and strategic partner, 25% is through ISOs. ISOs are definitely the highest cost channel, but there are costs to originating direct. There's marketing costs that we all bear as well. And so, I guess sort of no touch, if you will, is sort of what your question's getting at. I actually don't know if that's the goal. So what if I told you that we've sort of scientifically proven that when you add a touch, and about 80% of our customers will talk to someone at some point during the process, that conversion rates go up. Or lifetime value, retention rates of customers go up. So they might take more loans from OnDeck over a 3 or 5 year period than if they hadn't sort of worked with someone. So I think there's an intelligent trade-off to make there. Obviously, we're all super focused on lowering our cost of operation, increasing automation of the things we want to automate. But I do think there's an element of that personal interaction. Buying a loan online is more like buying, especially in the small business space, buying a car online than it is buying like a toaster. So I do think that's an element of relationship. We don't want to lose that completely.
Why do you think that PayPal hasn't been more aggressive in your space, and when do you start buying each other?
It's 2 questions.
Well, so PayPal does have a lending operation. We've actually gotten to know them rather well. What they're focused on, similar to the Amazon credit business that we were talking about previously, is really lending through to online merchants, which obviously that's a very important part of the market. The thing is, it's a pretty small percentage of the small businesses out there. If you think about those small businesses where you have a distribution or a data advantage, PayPal has that for folks who sell through eBay, although with the separation of PayPal and eBay, it will be interesting to see exactly how that plays. I don't know. But if you're talking about lending to a restaurant or a logistics business, it probably doesn't extend quite as well.
You've talked about this a little bit, but can you talk a little bit more about how you think about the pools of capital that you're allocating in terms of, what are you, is all capital kind of created equal? Is it duration? Are there any pools of capital on the lending side that are sort of strategic to you, and why?
Yeah, so I mean, on the Prosper platform, we the loans actually get distributed in 3 different ways. There's fractional loans, which is really where the retail investor plays. We have an active whole loan pool, and then we have a passive pool, which is people who just want to buy a representative sample of everything that's generated on the platform. They don't want to apply any screens or anything like that. And so the way we just keep it fair is we make sure we measure demand. We make sure that retail has enough loans that can get funded every day. Sort of, we have a automatic quick invest, and we can reverse engineer about where demand is, and we can make sure that's getting enough loans. And then we randomly allocate actually every single day to make sure that there's no adverse selection. So nobody gets better loans than anybody else. We just put them into the pools, and they get funded. And we try to just keep a balance. I mean, Jeff could probably speak to this, but our investor side team really makes sure that it's fair and that we're measuring demand and planning ahead so that the loans get funded. Because at the same time, there's this balance. You have to keep this balanced marketplace, and if the loans don't get funded, your borrowers have a bad customer experience, and it ruins the business.
Yeah, and I think what we really try to focus on is, again, how do we minimize intermediation cost? So if we sell loans to a large hedge fund who charges a 2 and 20 management fee and carry, and then they'll hire an investment bank to go do a massive securitization that's bought by CalPERS itself. So CalPERS is giving a large hedge fund money. They're collecting a bunch of fees. The investment banks are collecting a bunch of fees. There's a lot of fees in that chain. Now there's a place for that in terms of our capital, but capital is not equal. And when we think about retail, high net worth money coming from RIAs, that's much more attractive than getting capital from a large hedge fund.
Okay, I think we're out of time, but the panel will be around, so feel free to pigeonhole them over the course of the next day or two. And thank you all.
Thank you.